multiples matter, but we're always focused on net IRR. A lot of times they'll act more like the multiples actually matter. I'm going to get judged on net IRR. I want them to be judged on net IRR. I have some really great funds, or I have some funds that may look good on a net multiple, but are not great on the net IRR.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Welcome back, Superclusters fans. This is the homecoming episode. And for those of you who have been with us since season 1, today's guest should be no stranger to the podcast, who is by far one of the most candid souls I've met in the capital allocator world. And if you don't believe me, I'd highly recommend tuning into the prelude to this episode on season 1's post-season episode with Jeff Rinvelt and Martin Tobias, and why Jeff passed on Martin's fund. So, Jeff Rinvelt, and that's R-I-N-V-E-L-T, is a partner at Renaissance Capital, a fund of funds designed to be the bridge between innovation communities and strong industrial and commercial corporations. They boast a portfolio including the likes of Greycroft, Menlo Ventures, Sierra Ventures, Techstars, 5AM Ventures, just to name a few. He's an exit founder, a consultant, a VC, and now LP. We'll dive into a lot of this, and we talk a lot about long-term perspectives and how funds institutionalize into firms, and how Renaissance thinks about portfolio construction, not only for themselves, but in the GPs in which they back. And one of my favorite portions, and smart ways to think about how to exit positions, where I ask Jeff the canonical question of should VCs be public market investors? So the next hour is going to be action-packed. And so without further ado, let's dive in. Jeff, in like kind of a conversation before this offline, you had told me something really interesting, that you always thought of yourself as an engineer first and a finance person second. And I'm curious when that inflection first happened, when you first started taking that leap of faith into the world of finance, whether officially as a job title or just starting to dabble into the P&L statements or the balance sheets and all that.
It was actually part of the growth of a venture capital firm I was with. I was much more sort of the technical person. I was the back office. I was the startup person sort of at an accelerator, which role really well. But I if I knew I was going to stay there and sort of have my job that I really wanted, which was, much more on the investing side, I knew I had to start figuring out, accounting and books. And again, I'm a finance undergrad. I never had an MBA, which is highly unusual in venture. So I understood financials, but I wasn't as deep into them as before. And, basically I was thrust into the world of figuring out, generating the books for a venture capital firm, making sure capital account statements were correct and understanding even the financials coming from direct investment. So I got an MBA of hard knocks, and it's always, I don't know if you've gone through this too, but it's always those realizations where it's like, where you want to go, but there's going to be a lot of pain basically to get there. And so it was just sort of immersing yourself and making a lot of mistakes, and also finding the people that will coach you and sort of say, it's like, I don't understand this, and be exposed enough to figure that out. I've had another one too, where it was basically, I got to the point where it's like, okay, I can do the accounting side of it, but I also then figured out, it's like, if I want to go the next step, I have to be more outgoing. I have to be the person that gives speeches. I have to, and again, that's not my main, comfort zone. It's like, I'm very happy being inside spreadsheets, being inside in front of the computer. So again, doing podcasts, doing speeches, doing things that you just go to every event possible and figure out how to network. Yeah. Each one of those are painful events to get through it. But once you're there, it's like, oh, this is why I did that painful event. And I'm sure there's going to be a couple more in my career too. But it's that realization where you sort of have that night going, it's like, I know where I want to go, but I know there's going to be this valley of death in between that's just going to be very hard. But it's also a fun challenge too. It's like, okay, how do I figure this out?
You seem to describe yourself as an introvert. Let me know if I'm wrong on that assessment.
Yeah, no, 100%. Yeah, I will be spent after this. I'm spending.
I apologize for this podcast being taxing.
No. I get it. It's like, I want to do this, but it's like, this is not my comfort zone. Yeah. I don't know if it's you. Are you an introvert more, or are you an extrovert?
I'm an introvert.
Okay, that's why we
and
get along. There we go. Yeah,
that's why we get along.
But we're doing this because we know we have to. Yeah.
Yes, like after this, as much as I love the conversation, I'm gonna have to go and like don't talk to me for like another 3-4 hours mode, and just like focus on doing things because I really like
Yeah, this is
creating things.
nothing against you. It's just I
Yeah,
know myself. So yeah, yeah. But you also build up a muscle doing it too. So it's like you could do a half an hour,
yeah.
and then it's like you get better because and if I stop doing it, it goes away really quickly too. And then it's like so that's why COVID was so bad. It was like, oh god, I lost everything.
I mean, just like everything, whether it's networking or like, like finance or whatnot, it is a muscle you need to constantly practice and go to the gym with. And
Mm-hmm.
the muscle to practice, at least in terms of networking, is going to events, doing talks and building content and all that. And the gym is painful. I like there are, at least in my mind, like I go to the gym, but it's like, do I love it? Like maybe not. And so it's this is the reps you need to put in
Yeah,
effectively.
yeah, we need to do our reps. Yeah. So,
Yeah.
and that's what is interesting. So, yeah, it's like people go, "Oh, you're so great." It's like, yeah, I'm doing a good show, but it's like I would much rather be home reading my book or inside my spreadsheets or analyzing some new technology. So, yeah, that's more my happy.
But what does it look like for an introvert's journey into a what I might call an extroverted industry?
Yeah, I mean, I also think of it as my superpower too. Again, it's like, yeah, because I am introverted, I can understand technology more than some of the other people. Or I come from a technology background. I also take a technology mindset and sort of superimpose it over business plans and business, how they make money basically inside corporations. It's an engineering of how they actually make money, side of it. So I again, you always have to lean into your superpower, whatever it is, because again, it's not that you're doing something bad. It's much more it's much more knowledgeable to actually lean into what you do really well and use that as your.
Let's take a step back for a second, and I'm curious. I want to go back into the timeline, specifically
The
around
mists of time. There we go. Right? Yeah, exactly.
yes, mist of time, and specifically around the when you sold your company to Netscape. Um, could you walk us through the emotions you were feeling from as a in your first acquisition to Netscape? What was that like? What went on in your mind?
It was like an asset sale, so it wasn't an employee. I wasn't actually like changing jobs at that point. It was much
Yeah,
more sort of an asset sale, and it was during the period where they were half the company was going to Sun, half the company was going to AOL. I don't know if you remember that basically side of it. There was sort of a server division, and then there was the web page that basically went to AOL at that point. And that was the web page, which is actually more of an asset than the server division, the software side of things. So
hmm
we were part of that server side, and it was much more sort of an asset. So, and again, like lots of things in life, it was sort of, okay, I'm done with this. It's like, I just want this asset gone. I mean, and that's usually what happens with things too. Is it's like
yeah.
you feel it's going to happen way earlier, and then it's when it's actually happening and done, it's more like I just want this done because I want to move on to the next thing.
The next couple of years post the acquisition, you worked on a bunch of companies. Those didn't work out nearly as well as you would have liked.
Mhm.
What was the self-talk across all those companies? I'm curious, at what point did you decide to hang up the cleats and actually become an investor?
I actually sort of always wanted that. That was sort of my dream. Was it's like, okay, when I was in college, Red Herring magazine was around, and Mark Andreessen was always on the cover for Netscape for that, and basically I remember the quote where it basically says, I read Red Herring magazine. Andreessen basically always had those quotes before he was at VC. So I knew that was a world that I wanted to get to. I just had no way of concept. It was a hard enough concept to actually getting a Midwestern boy from Michigan into the startup world, which I knew I really wanted to, and then getting to that into the investment world, which is a whole different world. So it was a lot of just hanging around hoops, finding out where those jobs are in Michigan, just bugging people, showing up wherever they were. I would show up basically side of it. And then when you sort of had the opportunity to transition from that into a role, you just sort of, take it as much as you can and do as much to actually show that you have value. the truth is I feel like I'm still sort of on that rope where it's like, okay, I want to keep my job. I have to always add value. So it's always that, I like that, idea, but it's also, it's never feels comfortable, because it's like, this is my job. I want to make sure I keep it. And I always want to make sure I'm adding value back into the company. Yeah.
And so I'm curious now, let's fast forward a little bit on the timeline to the start of Renaissance. Maybe like roughly like Christmas of 2008. But I'm curious, and if I did my homework right, feel free to correct me if I didn't do my homework right.
That's fine.
The initial impetus to Renaissance, or like the preface to Renaissance, was there was a group of folks, of CEOs and leaders in Michigan who came together, the business leaders from Michigan, who came together to figure out the best way to create a venture ecosystem. And their answer, after much discussion, was the idea of a fund of funds. And so I'm curious, were you involved in that discussion of what did it look like to create a proper Michigan venture innovation ecosystem? And if you were, like, what was that like? What were the conversations behind closed doors?
I wasn't a part of it. I only heard it from other discussions. Actually, our chairman of the board was actually one of the people that was in the room then, Sam Valenti. So, shout out to Sam. But, you give it a lot more sort of, credence. This was probably one little line on a big plan. They called it the Road to Renaissance because again, it wasn't a big, relevation that it's like, Michigan is capitalized on, on automotive. It's like, everybody knew it, and so they sort of said, it's like, well, what do we have to do, or what can we do to basically make sure that this, isn't our future, or, it's a part of, automotive is part of it, but there's also a bunch of other things that basically said it. So again, a lot of really intelligent people were in the room that, created this sort of Renaissance. And one of them was, I give them a lot of credit basically side of it, because again, probably the most logical said was like, oh, we need to create a venture capital fund. And that was a very logical discussion. And there's a lot of other corporates or a lot of not-for-profits that have done that. This was a much more, groundbreaking with saying, so no, we need to create a fund of funds. And I think it made a lot of sense because it sort of gives you the freedom to say, okay, I can, I get a bunch of levers basically side of it. So I can say, it's like, I can invest in a fund and they can only do, one or two investments in Michigan, but I get to have that lever of them being able to pick and choose what they want in Michigan. So they're saying all the money needs to be invested in one region, where it's like, there may not be any good companies, or maybe one or only one good company in that region in fintech, or
right.
So that the other side of it, which I don't know if which I think we only figured out later side of it too, was it's like having these corporations as limited partners was also a great sort of flywheel side of things, because again, GPs want access to them as as thinkers, as M&A clients, as beta customers. So having those two connections and sort of being in the middle of it was one that, I don't know if everybody understood, but it's like it took even us a longer time to understand and make sure those all flywheels are things that actually help you make better investments and actually have better return.
How did you eventually hear about this discussion that went on that ended up becoming a line item of like, we should start a fund of funds, because you promote the overall venture ecosystem that way? And what was the motivation? Because you said you wanted to be an investor. There's a big difference of like, I want to join another shop, be an investor there, to I'm going to start a fund of funds. What was that conversation, or what was that like?
So I was working for a fund at that point. So I had already made the transition sort of from a product manager to, okay, I'm a finance guy, a little bit of investing side of things. And I knew I wanted to sort of stay in that realm, because again, it's a great life. And so there was a couple other options. Basically, some of them were even like hedge funds and some other things. I started looking at hedge funds, and it's like, okay, this could be interesting. And it was much more sort of the fund of funds was the one that sort of bubbled to the top. It wasn't a clear message, and it probably wasn't even, the one that looked probably the best on paper. It was just the one that it was like, okay, this is, I like the, people I'm doing it with. I like Chris Ryzik. I worked with Chris Ryzik. I had already set up that trust with my partner, basically side of it.
Yeah.
And, this sounds interesting. This is a new thing to learn, basically.
Yeah.
So, again, there is no clear path a lot of times, and a lot of times we rewrite history back inside of it. But it was the one that bubbled to the top, and it turned out to be the right choice.
So to flip gears a little bit here, I want to talk about fund size, at least like the first fund size. I believe your first fund was $45 million. And when you raise that, I think you've publicly said that $40 million is roughly like the minimum viable fund size for Renaissance, actually down by half your original proposed fund size. What was it like? And how did you arrive that 40 million was the lowest you were going to go for a fund of funds?
So the model of a fund of funds is less. I mean, it's not 2.5 and 20. It's usually, I think industry average is about 1 and 5. 5% is very, normal for carry. 1 can be wiggly. It can go lower or higher. So, doing the math, 1%, 400K a year, and making it viable with 2 people and offices and expenses, it's very hard to run an office that way. So, startup people run with very low salaries. We were running with very low salaries. And I had another job at that time too. So I was more half-time. Chris was 100%. My partner was 100%. So, and then we had a bunch of support staff too. So again, we sort of did the expenses, and it's like, okay, this is what we can live with, and everybody was sort of like, okay, I'll sign up for this, this is what I need to live on. It was all horse trading. And even then at that point, again, to give us props, it's like, Business Leaders for Michigan gave us a loan initially that we paid back basically just to get going side of it. When we finally get, the bump from 40 million to 45 million was a big deal, because that was another, just even some more money we could have per year and would allow us to survive, another side of it. Also, the consideration too is it's like, okay, after the investment period, it starts going down. So you want to raise a fund as quickly as you can. If you can't, then you also have to have a plan. It's like, how can I operate this for the 10, 12 years that I've signed myself up to, and that I've basically given my word to this community side of it. So you really have to look at it. It's like, okay, what's my plan if I don't raise another fund? Because you still have to operate this.
Out of curiosity, what was your plan if Renaissance didn't raise another fund?
I wouldn't have had a job, and it would have been Chris running it as his secondary job, basically. But and I give Chris lots of credit too, because he signed up for much more than I did. He was basically signing up for 12 to 15 years of his life. Thank God we went on and raise a much more funds after that, but it could have turned out much differently, and he could have had a company, basically a fund that he was babysitting for a number of probably right about now. Yeah.
Right, that's true. Like 2008 till now, that's roughly when fund cycles are.
Exactly.
And it's weird to think about this, because in some ways it is short on the venture timeline, but it is very long if you think about it from a human perspective. You're allocating a double-digit percentage of your lifespan towards something, like towards something that could or could not work out. There's a high risk.
That's not your children. It's not it's not. Yeah, exactly. I mean, we definitely give 20 years to our children, to our spouses, but this is a long time frame, and to sign yourself up. And again, this is a community that both Chris and I wanted to be part of for the rest of our rest of our lives. And so we're looking people in the face and saying, no, I'm signed up for this, and this is the we really are signing on the dotted line, and we believe in this, in this vision, and this is what we're willing to do because of it. So, a lot of times, emerging GPs haven't thought that all the way through, or haven't figured out the whole thing. Because again, it's a conversation. That's why a lot of institutional managers want after a fund 3, because that okay, they've already have enough of a fund life, they already have enough of management fees. They're probably going to continue for the next viable period, basically. Yeah.
Did you, and feel free to push back here, did you guys find any way to engineer, so to speak, the 1 in 5, or I think in some ways I see like 1 in 10 model, in the sense that you would take more in the deployment period and then you would cycle it down? Because I've seen this a lot, right? You would start off with, like, I'm making this up, like 1.5, right? In the first 5 years or so, right? And then you bring that down to like 0.5. percent management fees for the next 5 years, assuming it's a 10-year fund. And so it rounds out to about 1%. Did you play with that mechanism as like, it's going to give us enough liquidity to actually focus on this business before our fund 2 and fund 3? Was that something you guys played around with?
Yeah, I'd have to go back and look at our math, but I think there was a little bit of that, front loading of it basically. And again, as a first time fund, you have to do a little bit of that or, side of it. And again, some of our sibling funds around the country, Centrifuge, Houston Exponential, and, NVNG, they're doing some of that same math basically side of it. But again, it's been 15 years. I'd have to go look at our original LPA, basically to find out exactly what that math looked like. But again, to go back, I think the flavor of it is it's like we were not paid a lot, at that initial side of it. We were sort of betting, both our monetary, but also, just careers of our lives that we'd have to sort of, live with this fund for a longer period of time. To his credit, Chris probably more than I.
I wouldn't downsize yourself. I wouldn't discount the amount of conviction you'd have, because this was still like the opportunity cost is extremely high, just because you had opportunities to go to a hedge fund, you had other opportunities, and you chose that this is what you're going to spend your time on for the next like 12, 15 years, at least for even that's just a single fund of funds, right? So I wouldn't discount yourself. To switch gears a little bit here, I want to talk about portfolio construction a little bit. A lot of LPs, obviously, you have your own way of thinking about portfolio construction. Actually, would love to hear how you guys think about portfolio construction as well.
Yeah.
Well, actually, let's start with that. This is a bit messy of a question, but how do you personally, or how does your team at Renaissance think about portfolio construction in the way you allocate to venture funds?
Yeah, I'm in a unique position where I have just VC, and I'm actually in an enviable position because, again, I'm on some other investment committees and I see their, issues on how they allocate it. Again, sometimes it's just the private equity. They just have a bucket for private equity. But then it's like, how do you divvy up between VC and hedge funds and, and buyout, all these other, other great asset classes. So, for me, I got a pretty easy job. It's like, it's all venture capital. But for us, it's like we start to, divvy it up between early and late. And so early for us is seed, Series A. And we like high concentration, high ownership investors. So we like people that do double digits, that sort of have follow-on models. Again, we're not sort of the people that like, sort of market-based side of it. So we're much more sort of tilted towards the early stage. Again, I think those returns have been sort of better in the earlier stage too. So we're about 70% of that, 30% in the growth. And again, for growth for us is, again, it's a bigger bucket. So it's probably, sometimes it's even Series A. It can be Series A, but it's usually like Series B and beyond. Once they start getting into the control deals, that's usually where it stops being, a venture capital deal. But even then, it's like sometimes control deals have venture capital returns. Again, it all depends on the manager and your relationship with them and how they sort of fit these buckets. Then we start to segment it sort of by industry. And again, the two big buckets, again, we're rolling up big buckets. So it's like, it's going to be healthcare and IT. And again, healthcare can be anything from a device to healthcare IT to pharma. And so that's usually 40% of the portfolio. And then we have another bucket called emerging. Emerging for us is things that we think Michigan's good at, but it may not be, big enough for a fund, or they may be just parts of funds. So we've got agriculture in there, a little bit of automotive and advanced materials.
That makes a lot of sense. And I assume that goes a lot to inform like how you deploy. One of the things I'm curious about when you're underwriting both early stage and growth, what are the multiples you're underwriting to? Are you underwriting like, let's say, early stage to a 4x, 5x net, and then growth to a 2.5, 3? Like, how do you guys think about that?
Yeah, again, it's got to be good for that vintage. The past performance. And again, we're always focused. Multiples matter, but we're always focused on net IRR. Again,
that's interesting.
We have a hurdle. And again, as you start to get more and more into all the private equity, net IRR is the one that really, it's like, I know how my GPs get paid. And again, a lot of times they'll act more like the multiples actually matter, but it's I'm going to get judged on net IRR. I want them to be judged on net IRR. So I have some really great funds, or I have some funds that may look good on a net multiple, but are not great on the net IRR. And so it's like, I probably won't re-up with those. So it's like, I care about and again, I'm trying to understand, it's like, I want to do a certain return back to my investors. And again, I have to, my fees are still fairly high. I mean, it's lower for than private equity, than venture capital, but it's still right in line with a lot of other funds. So I have to make sure that I do that plus my fees. And so we're somewhere in the round of like 20, 25 is sort of a number that again, I'm going to have losses, or I'm going to have funds that I don't pick well. So it's like, I'd much rather have a fund that does better, side than the other side of that.
I am curious in terms of, so we've had a couple people on the podcast so far where we've heard both sides. We have heard people who have like sworn by IRRs, and we have people who swear by TVPIs and DPIs and all that kind of stuff. And I probably at some point should have a debate between all of you guys of like,
yes, I would love to hear that. Yes, I would love to hear that. Yes, yeah.
Because there are valid reasons on both sides. So I'm curious on like one of the strongest proponents for why one quote unquote should not be measuring by IRRs for venture is the fact that it's easy to game the IRR game, right? Like if you're investing in early stage, some people count marks as like, for valuation caps and safe notes and convertible notes, which technically aren't priced as a markup per se. And so there are easier ways to game them. You can raise a bridge round on a higher valuation cap and you're like, oh, look, my IRR went up kind of thing, right? How do you do I guess my question for you is, how do you do the homework, and how do you actually count marks? What marks are real marks and what marks are just like GP saying they have marks and you're like, I don't actually think you can mark up that portfolio company?
Yeah, you're definitely right. And then there's also the argument for public market multiples. And again, you started getting into the where you're competing against public market securities and private market securities. You do have to have a weight discussion, but again, net IRR at the end of the day is the one that's probably going to work. It takes a while for it to bake, though. Again, I mean, 5 years, 6 years in, it's gonna be baked basically. 10 years, it's definitely going to be baked basically. So again, there's usually three numbers that we look at and that we sort of present to our advisory board, and numbers that we always look at. It's like, yes, it's TVPI, but it's also DPI. Again, in this market, DPI is probably the only
right
thing
now
that matters. But probably to we've swung too far the other way. You can have that discussion too outside of it too. But again, net IRR should be in there, especially if you're after year 5 or year 6. Again, you should that number should matter. And if nobody's even tracking that in their fund 3, it's like there's probably something wrong with it, because I know they're getting paid on TVPI. I'm getting paid on net IRR. So it's like, I care a lot about that.
Now to talk a little bit more about, like, you invest a lot of like emerging managers and like first time fund managers. And I'm curious, obviously when, like, before they actually have a portfolio, maybe they're like a fund 1, fund 2, especially if they're a fund 2, they're still too early to actually look at net IRRs, to be completely honest. It's probably close to 0, if not like 0 to 5-10% kind of thing. For you, how do you look at when a fund manager comes to you with a portfolio construction model? Because a lot of LPs obsess over the mathematical specificity of a portfolio construction model. But in your opinion, how much of a model is actually a top-down exercise until the math actually works out?
I love this question, basically, Simon. But we've actually seen a bifurcation. Again, if they're highly, financial people, they'll do the model all day long. But then there's a lot of entrepreneurs that become VC, and the model's not even there. They haven't even thought about portfolio construction, or they haven't even you start having the conversation. It's like, well, how much ownership do you want? It's like, no, I'm just picking companies. It's like, you're not picking. I mean, I'm just picking and advising companies. Like, no. Let me side it. There is a financing side of it, to the side of it. So, the line always is for me is it's like, you got to pick well, you've got to coach well, and then you've got to finance well. And financing, including exits, basically side of it. So entrepreneurs will take it and not even have a model. So I've had lots of conversations with funds 1s too, where it's just like, what do you mean? How many companies I'm going to pick? It's like, well, what's your target ownership? Well, whatever I can get. It's like, I'm just buying a company. It's like, no, you can't do that. And then there is the opposite side, where it's like they believe that they can create a model and then run that model. And we know that also that's not true, because it's like, okay, I'm going to have 2 unicorns. Okay, yeah, you're not going to have 2 unicorns. You're not even going to have.
I wish that were true. I wish you could wave a magic wand.
It's like, look, the model says I'm going to have 2 unicorns. There we go. Yeah, exactly. And so I've seen the both sides of it. And the truth is, it's somewhere in the middle. You should have a model. I mean, and I don't know if it's a model, but it should be a strategy. Again, I just laid out my strategy. And there's a model behind it, but it's not the model where it's like, okay, I need one fund that does this return and one fund that does this return. It's like, I need a blended return of this, and I want the highest return I think I can, and I'm going to pick the best funds basically because of that side of it. So if you're doing much more details where unless it's fun for you, I don't think it's a worthwhile exercise basically side of it.
So it sounds like for those fund managers who do like Monte Carlo simulations, you're like, like you can do that, but it's like, I don't know how much like truth it's going to actually follow this probabilistic.
That's a good way of saying it. We are not in the Monte Carlo, simulations phase at all. We're basically an Excel spreadsheet where it's like, I'm going to get this, I'm going to do this much, early stage, these many investment. Again, you've got to have enough diversification where you think you can actually get enough home runs too, basically side of it also. So there's this balancing act between reserves and I think it's a much more interesting conversation to start to talk to these fund ones, fund twos, and start to say, it's like, okay, when you're at fund 3 or fund 4, what do your reserves look like? What does your count look like? How are you going to scale it? So you're going to just scale it by number of companies, or are you going to scale it by, by reserves, or are you going to scale it by, different ways of doing things? And again, that sort of gets down to the strategy of it. And again, that, I have my own opinions on that. So this allows them to say, it's like, hey, you're probably not for me. You're probably for somebody else who's looking at a different kind of model.
What are your thoughts on reserves?
See, I'm a high reserve person. I said that. I tried to signal when I'm talking to GPs too. It's like, I'm a high conviction, high ownership, person. So yes, I like double digit ownership and I like some follow on. It's usually like 30 to 50%. So again, that can be very high.
That's aggressive.
No, but again, it's a good way to scale a fund. I mean, we've seen funds that start at 25 million and then they're $100 million fund, and they can sort of keep close to the same number of companies. Again, that means the managers don't have, the GPs don't have to change as much. They can keep the same amount of board seats. And if you think about it, reserves are fairly easy questions. I mean, they're hard because you want to do the analysis, but they don't take up the time and the relationships that those early stage where it's just blocking and tackling, finding the deal, making sure you can close the deal. These ones it's like, are you in or are you out? It's like, okay, hopefully you got enough information and you can make that decision. And you got to make sure you do it correctly because, again, it's a different skill for picking than financing. But again, it should allow the firm to scale and then still make very good returns on their capital.
I'm curious, is there at Renaissance a re-underwriting or like just like a like understanding if the difference between making a first check investment and the difference between making like a reserve and follow-on check, like the rationale is actually quite different in my opinion. Because one, you don't have an information advantage. Other, you have an information advantage. Two, like, if maybe your value add as a manager is a go-to-market strategy, and you're like, I know everything about like, how to get to market. I know what metrics to be looking at. And then you get to like Series A and Series B, and you're like, well, that's a bit more financial engineering at that point. Good examples of answers that managers have given you in terms of it's given you conviction and confidence that they're able to make reserve decisions on top of making their initial check decision.
Hopefully, again, it's like there's a process there, and again, there should be a process around the picking. There should be a process around the coaching. Again, I'm using the word coaching. It is basically just helping them out, and then there should be a decision around that that follow on rounds, but also that exit round. How do you exit these companies? Because again, that's another choice too that we've seen. Frankly, do mess up GPs. So all the side of it. But again, it's looking at what choices they made before, or showing us like, okay, I learned here. This is what I'm not going to do next side of it, or I learned on somebody else's dollar. This is what I did wrong, or these were the SPVs we did, and I wouldn't do this one or this one. This is what I'm learning. This is why my reserve status is this way. And again, it's a perfectly great thing to say. It's like, I'm a great picker. I'm not going to do those follow on. I'm going to give SPVs to people. Again, that's a very good. That's just not my investor. I'm just not going to invest in those people. Yeah, but it's great for other people because they want to do SPVs, and they want to be able to follow on that, in very low fees. I'm very happy with giving that to the manager. But you're right. I mean, it's a very hard skill. It's a muscle. Again, you need to have. And again, there's certain people. Again, there's team members sometimes you can point to, and we're starting to say that a lot of those skills were already baked in. The ones that wasn't baked in a lot of these firms was these exit managers and people that side of it. Even in the early stage, they're now having, SPACs, they're now having M&A people. Again, these are whole different financing rounds where it's like, okay, you can sell as much as you want. How much are you going to keep on the table? How much are you going to take off the table, basically, with this next M&A round? That's a tough decision. That's a lot of decision. There's a lot of things you got to think about. So people that are focused on that, those type of managers are impressive to us, and we've sort of talked to all of our managers and said, okay, if you don't have it, there should be somebody that it's their job to sort of look at exits for the side of it, even if you're early stage, because there's choices are going to happen.
Okay, and I love that you brought up selling or exiting positions, because that's a really interesting topic, because the goal of every investor, no matter what financial asset class you're part of, is buy low, sell high. That's the memo, right? And I think VCs often over-index on the buying part of this, but not the selling part of this.
Without a doubt.
Not at all.
Yeah, we are built as pickers. I mean, and especially even entrepreneurs are even more, because you've got one basket. You've got to be really good at picking. But once you start becoming a VC, you have a basket of 10 to 12, or more companies.
Yeah.
You've got to be good at picking, but also at those, or you lose those skills or those hammers, basically, side of it to affect it. Especially in this market now, we're seeing financing, even great companies with those cram down rounds. It's like, if you don't have capital, you're writing off a lot of assets.
Yeah, that's true.
Yeah.
And so on that kind of note of selling and thinking about selling, I have two questions here. You can take it in whatever order that makes sense to you. One is, should VCs be public market investors? And that might be like an interesting rabbit hole to dive down, because, if you really do have a unicorn and you can, you have obviously material kind of like non-public information, not in the sense of like you had it like post IPO and all that, but in the sense that you've worked with this founder for like 9-10 years. So you kind of know how they think, and maybe you think the public markets are like inequitable kind of thing to kind of the company. Do you think VC should do you think VC should hold on assets post immediate liquidity exit opportunity element of it? Actually, let's start with that question. Should VCs be public market investors?
I say yes. I mean, without a doubt. I mean, the market is making them be public market. Again, those hold periods are very long now. I mean, and a lot of times, especially in pharma, those were basically old Series A's. The people that, the old model of saying basically, it's like, once lockup happens, you sell. It's like, we've seen a lot of firms basically, mess that up, or basically then they figure out the math and it's like, oh, I left all this time on the valley. But then there's the other side. It's like, well, okay, when do you sell? And I think the best answer is sort of when it hits a point, especially in pharma, it's like when you know some information, or when it's sort of hitting your thesis basically side of it. Again, we now have a bunch of SPACs even now, on the IT side of things. And it's like, that didn't turn out great, but there are some that have turned out great. And it's like, how long do you hold on to those? When do you, sell on those? It's just a whole big difference. The other question though is it's like, we're seeing a lot of firms, especially the bigger firms now are becoming registered because they want to hold more public stock. Not even ones that translate from an IPO. They want to be able to buy into or even buy public, shares. We're seeing that. We have some in our portfolio basically that will buy public, because again, a lot of these assets, especially on the pharma side, again, they're Series A's. And a lot of times you can get them at lower values than they were even at the seed value basis side of it. And they're so under tracked or represented basically by the bankers that it is basically playing a VC, a venture game. On the IT side, it's still TBD. There are some, companies that are doing really well, but yes, I think you're by definition, you're going to have to be a public market person if you want to or not. And so you better be good at it, or at least have that information to be good at it when it does happen.
I've heard the flip side of this, where people are like, hey, VC shouldn't be public market investors. The product in which LPs are buying is a private markets product, and in many ways, because LPs have buckets, like we have a public markets bucket, we have a private markets bucket, we think people should stay in their lane. And the flip side of this is when GPs have communicated like how they think about selling. Let's say it's a really great company, they think it's going to go much further. What I've seen certain VCs do when they have the opportunity to hold for IPO and hold past IPO is they would get 50% cash back to their LPs and 50% still in stock. And they're like, hey, we're personally reserving like our GP carry. We're still saving a lot of it in kind of stock and shares and all that because we do believe in the long run future of it. But because we are private markets investors, we will give those shares to you and let you make those decisions. But we'll just inform you that we are personally holding ourselves.
Yep. And that's a great decision too, basically, side of it. So yeah, we've seen lots of, but again, a lot of times those same decisions are happening at lower down the scale with PE buyout. So it's like you got the same decision. It's like, okay, you could sell all of your shares to this person, or you can basically take half of it. You can take your beginning size off the share and then let the rest of it ride. So if you're making those decisions, it's sort of the same motion. You know what I mean? So why don't you get good at it and figure out, what your strategy is? And again, I think it matters per asset. I mean, there are some of them where it's like, okay, this is overvalued right now. It's hit its inflection point. Sell it. You know what I mean? Basically side of it. Or, I think it's already overvalued, or it's not going to go higher. Get rid of it. You do think it's still going to get that, that growth bump of 20, 30%. Hold on to it, or communicate some way to the LP that it's like, this is what I'm doing with my personal share. But give me. That's
amazing. Option. We are in the back half now, and I don't want to take too much of your time because we're recording this on a Friday, and I'm stealing Jeff's Friday away from him. But I'd love to go into the quick fire round of questions. So kind of to start things off, I will say my questions are shorter in nature, but in some ways, if you have a longer answer, feel free to go longer kind of thing. Sometimes we have
you can cut me, right? Yeah, you can edit me.
We can edit
editor. Yeah, yes. Yeah, exactly. What's your editor's name? I got to be nice to him. He's got to
Tyler.
Okay, so Tyler better make me look good. Okay.
Tyler, that's your job. And if you want to comment on screen as well, like feel free to. But Tyler's phenomenal, and we've been working with each other since the beginning, and both of us have grown over time. And I will say he has a much better eye for content than I do. So, Tyler, I appreciate you. So, to start things off, and this is a question I've had in the Rolodex for a while, but I haven't had many opportunities to actually ask this question, which is, if you were to have perpetual capital, evergreen capital, how does that change your mindset as an LP? And if you do have it, how does your mindset change if you didn't have it? I assume it's probably the former.
I actually had this question just the other day. Somebody on a panel asked somebody else. It's like, they listed all the reasons why venture capital is broken, and they were like, well, if you had to redesign venture capital, what would you do with it? And I'm like, how would I answer that question? It's like, okay, I think evergreen capital is the wrong way to go. I really do. I like the short-term nature of it. I like the, being able to fundraise, basically the vintages side of it. I don't think an evergreen, and I've seen a number of evergreen vehicles, and I know it's done very well in Europe. So there's been some very, successful side of it. But again, I liken this business where it's still sort of Wild West, or it's still sort of emerging. I mean, again, venture capital hasn't been around that long compared to a lot of these other asset classes. So I think we need the nature of having something that's not evergreen and being able to fundraise, being able to have a set life of it, or have a beginning, a middle, and an end to it side of it, and then being able to be judged on that. So I don't think I would go to evergreen. I don't think it's the right vehicle, at least at this current time where venture capital is.
For the sake of quick fire on questions, the next question over here. In your experience with your best GPs, actually, what typically comes first, the intro meeting or the deck?
I like decks first. I actually read the deck, and okay. I know a lot of GPs actually, tell me, it's like, I'm not going to give you a deck because it's like, you're not going to read. It's like, no, I read the decks. I really do. So, and again, I'll usually even ask for a deck. It's like, here, give me a deck, because then I can sort of tell you really quickly. It's like, you're not going to get, I'm not going to invest in you this time. This is only an intro meeting, so I can set expectations. Or it's like, You're not going to be a fit for me side of it. Because again, it's like half an hour, 45 minutes. That's a lot of time. I can get through a deck pretty quickly. And again, you can start to see it's like, okay, is the deck 30 pages? Is it, it doesn't have the standard, it doesn't have the standard 10 to 15, it doesn't have the intro slide. It's like you can start to get a good idea of where that person is in their journey as a GP.
Last question here, which was not on the schedule. I'll be completely honest, but I've been staring at it this entire conversation.
Yes.
For the folks that are not watching the video and are purely listening to this, Jeff, you have a sign behind you that says, "I am trying to break your heart." I have to ask, why is that there, and what meaning does that hold for you?
Everybody asks that, but it's basically that I'm an old dad, and it's like that's a line from a song, a Wilco song. So if you want to, again, you can tell I'm dad rock. So it's like there's, Jeff Tweedy and Wilco is sort of my jam right now. So it's like that's why I put that on there. It has nothing to do with it, And then the other one's a Star Wars quote. You knew the Star Wars one, probably,
Yeah, no, I got the Star Wars side of things.
Oh, okay, there we go. Yeah.
The I'm trying to break your heart. I'm like, where does that actually stand? This looks like this is your office. At the same time, like maybe it's like you're talking to a bunch of GPs. And it's like, hey, you know what? In case this isn't clear, my first meeting, this is what I'm going for, which is I am trying to break your heart.
I'm always trying to be honest. I mean, but it's always that honesty with heart, or honesty with with being kindness on the other side of it. And I'm probably more honest than I am kind, or side of it. But it's always trying to do those together, and that's always in the back of my brain. But yeah, it has nothing more. It's just like I like Wilco. So there we go.
I love it, Jeff. I appreciate you. As one last thing, and I think people have, for those who have tuned into the postseason episode for season 1, I think you already shared there, but in case people haven't, where's the best place for people to find you? Because you're in a couple areas. Where's, like, for LPs who are thinking about, like, allocating to emerging managers, or how to, think about long-term firm perspectives and all that, like, where do people find you? And obviously I'm sure there are GPs watching here as well, and they'll find the same channel.
Yes, again, I'll always try to be kind to those GPs that reach out to me after this. But yeah, I'm at Renaissance. We didn't get a great domain, so it's RENVCF, venturecapitalfund.com. So renvcf.com is sort of my home. You'll see, again, we've only got 5 people, so it's a fairly small team, so you can find me there. I also have a stub page at jeffrinvelt.com. It's RINV as in victory, ELT.com. And so my email is jeffr@renvcf.com.
I've just realized something. I think you just pronounced your last name as Rinvelt, and I think I've always used Rinvelt.
I go by either. I'll take either. No, I have no problem. Yeah, it is. I mean, it's Dutch, so it's sort of Velt on the Rhine, and then RHINE, and then they drop the H and the E, so it's But I will answer to either. I'm Jeff. Call me Jeff, but yes,
Mr. Rinvelt, Mr. Rinvelt.
Oh, thank you. Now you're going to make me feel. I just did dad rock jokes, and now you're going to call me Mr. Rinvelt. Like, oh.
No, you're Jeff. You're Jeff to all of us here.
Thank you.
And you'll have folks reaching out. Maybe their subject line is "I am trying to break your heart," and you'll know where they might have heard this from.
David. Or I like Wilco also. There we go. We'll take that.
There we go. I like Wilco. Jeff, this has been super fun. And if I were to break just one more collective heart out there, to all our Superclusters fans, this is a wrap, and I'll see you on the next.
You always have to lean into your superpower, whatever it is.
I want to give a special shout out to today's sponsor, Alchemist Accelerator. Backed by the likes of Khosla Ventures, Mayfield, Salesforce, just to name a few, Alchemist is the top B2B startup accelerator that's been around since 2012, backing founders from day one. And if you've been around for 12 years and running laser focused only on one industry, you build this incredible set of flywheels, and positive feedback loop is absolutely insane. We back the best enterprise talent who go on to change the world in which we live in, who then come back to their hometown, coach, and mentor the next generation of world-class enterprise talent. And don't take it just from me. Alchemist has backed the likes of LaunchDarkly, Rigetti, Privacera, MoEngage, FarmWise, just to name a few, many of which who have come back as mentors and coaches for the current classes of Alchemist. If you're curious and want to get more involved in the Alchemist ecosystem, check out alchemistaccelerator.com/superclusters. That's an S at the beginning and S at the end, and we'll include the link in the show notes below. Till next, stay awesome. Hey, Superclusters fans, David from Post here, and if you're tuning in from Spotify, Apple Podcasts, or wherever podcasts find your ear, it'd mean the world to me if you left a review. For those from the YouTube universe, let me know if you agree or disagree in the comments, and it'd mean a lot to me if you could share this episode with just one other person who'd get a kick out of today's topics. I'm on the road to publishing to at least 100 episodes of Superclusters, so every comment, question, review helps me make this experience more helpful, exciting, and fun for you. And lastly, I want to share a quick disclaimer. The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. See you on the next.